Good morning, ladies and gentlemen, and welcome to the show on this 22nd, Thursday, the 22nd of October, 2020. Glad to have you guys here. Now, let's get started. Let's open up the charts right here, and let's take a look at what's going on. Central bank digital currencies. Now, I found this article in here that was written by the boss of Binance. His name's Chang Pen, and, they said that he said that central bank digital currencies could threaten Bitcoin. But they got his actual statement here, and what he really said was, if there is a government pushing another cryptocurrency that's even more open than Bitcoin, more free than Bitcoin, and has less restrictions than Bitcoin, and is faster than Bitcoin and is cheaper to use, then it would threaten Bitcoin. So he put in, they made it sound like he said that it would threaten central bank digital currencies are going to threaten Bitcoin. But he said that for them to threaten Bitcoin, they would have to be more open. You tell me if the central bank digital currency is going to be more open than Bitcoin and more free than Bitcoin and less restrictions than Bitcoin. It's going to be exactly the opposite. These central bank digital currencies are going to be more closed. They're going to watch you and scrutinize every transaction. They're not going to be more free. They're not going to have less restrictions. They're going to have more. And maybe they will be a little bit faster. This is possible that they're faster. And maybe they will be a little bit cheaper to use. But they're going to be able to watch every darn thing you do with these. Now, let's take a look at another aspect of central bank digital currencies. A German official here, within the banking system, German central bank, is looking at these central bank digital currencies. And, one of the problems they're seeing with them right off the get-go is that people will be able to take their money out of the bank and put it into the central bank digital currency because they don't deem the banks as a safe place to keep their money. They're worried about this, that the regular legacy banking system, people's bank accounts and stuff, like when they bring a central bank digital currency to the United States, they're worried, the countries are worried that these people will go out there and empty out their account and deposit it in their new account of a central bank digital currency. And it'll create bank runs because this is basically that they'll use it like a bank, Now, the central banks, they don't want them to do that. What they want them to do is they want to be able to inject money into these people's accounts, central bank digital currencies accounts, and have them spend it. That's what they really want, They don't want them to use it as a savings account, So I'll tell you what I see coming in all of this. I see the central bank digital currencies making it a timestamp on your money so that you don't use it as a savings account. Maybe a 6-month timestamp. In other words, you got to spend your money in there within 6 months or it just vanishes. And so they're going to prevent people from using these as savings accounts. I'm almost certain of they don't want to destroy the regular banking system. Let's just take a quick look at some of this. It says Burkhard Batz, a German politician and executive board member of the country's central bank, said in a speech on October 20th that it was crucial to build tools to restrict how the digital euro is used upon launch. He emphasized that people should only be able to use the central bank digital currency euro, as a mode of payment and not as a store of value. See what they're worried about? They're worried about the other banks in Europe. People pulling their money out of the bank and depositing it in their central bank digital currency account. I can see them putting things in there to keep people from doing that. And one of the biggest things I can see them doing is this timestamp. Anyway, let's move on and take a look at the silver price today. We're down 49 cents, which is quite a significant drop in the price of silver today. This is this thing we're seeing happen. We're seeing when the stock market drops off now that they're selling their digital, not digital, but their SLV and their GLD. They're selling it, which is paper contracts for gold and silver. They're not selling real gold and silver. They're selling paper contracts for gold and silver. But that paper determines the price of the real metals, you know, and they're knocking the price down a little bit. And this is because investors out there right now are not really scared. They're not, gold and silver is still to them just a speculative asset, you know, and they're, okay, we've got a lot of people out there who use gold and silver as a store of value. Stackers and stuff like that, you know, and they won't part with the real physical metal. But these guys are just speculators, and they're just parting with their paper derivatives product. And that's what's affecting the price and bringing the price down on days like today. And whenever the stock market falls, they'll sell off some of their GLD or SLV in order to make good on their stock market speculations and stuff, you know, and this is affecting the price negatively, but it doesn't take into consideration the real underlying asset at all, you know. If the price goes too low in the spot price, you know, we're going to see the physical all disappear. And especially with silver. Now, you know, they had a little bit of an inventory build over a few years ago, you know. Leading up until this last year, they had a little bit of an inventory build in silver. I think we're mostly ate through that inventory build, this massive demand that's occurred over the past few months, you know. It's hard to tell just exactly how much of that inventory build that they still have on back supply. In other words, that they can keep feeding the market with physical demand. It's hard to tell how much they got in reserve that they can use for that. And so when are they going to run short on silver? You know, this is the big $64 million question. It's hard to tell exactly, but when they do, we would see a massive price spike increase, you know, if they actually run out of silver. And it could happen suddenly. It could happen at any time. It could happen tomorrow, or it might happen 2 years from now. But ultimately, they're gonna start running low on silver, because if the economy starts to pick up in the world, say a year from now, then demand for silver will pick up, you know. And what's the price going to be if the world goes through an economic depression, which is what we're actually in, you know? In other words, that tends to lower the price, deflation. But on the other side of that, when central banks stimulate, they drive the price up. So we're caught between pulling forces that pull in opposite directions right now, you know. And so these speculators are selling off some of their paper silver short contracts. Let's take a look at gold today, see what it's doing. Gold's $19.0170. It's dropped to $22. It's just holding its head above the $19 mark. Seems like gold has a pretty good little floor in there around 1900 now, you know. It's established for itself. This is consolidation, what's been happening with gold and silver over the past few weeks. You know, it's been consolidating at these newer, higher prices from where it used to be. Cryptocurrency today, $394 billion, 60.7% Bitcoin dominance, with a Bitcoin price at $12,923 today. Let's take a look at the stock market today. And we're looking at the Dow's down 22 points on the day so far. Until they get this stimulus stuff done, you know, we're going to be looking at these doldrums in the market. Let's take a look now at crude oil, $40.88 on the day so far. It's up 85 cents. They're really keeping it at $40. You can see that. Ever since that drop in price that went down below $40 negative on oil, they've been keeping it right at $40. Boy, have they ever been doing a good job of keeping it at $40. Now let's take a look at bonds and rates. These bonds are creeping up. They've been creeping up, and they are creeping up. We got the 10-year now at 0.84, and we got the U.S. 30-year at 1.65. And they're up almost 3 basis points on the 10-year today. These bond rates are creeping up right now. The MOVE index today, we're looking at 5908. It's down 2.23 on the day so far. This is one of the most important things out there that the Fed's going to be looking at. And as long as this stays down under 100, well, they're going to hang a little bit tight on these stimulus and stuff, because I think this is what drives them to do the stimulus. You want to know the truth? If this goes over 100, this MOVE index, then they start worrying about the credit markets. And this is probably what will drive the next stimulus to happen when this MOVE index goes up. So we watch it like a hawk. It's been going along pretty steady ever since October 5th, where it took a bounce upwards. It's going along sideways, really. Let's take a look at the dollar index, 92.88 on the U.S. dollar index. And basically, it's kind of going along sideways today. Let's take a look at our funny picture today, and let me expand it here a little bit. Where's my button to expand it? Beware of cat. He's a real tubby one, isn't he? I'll tell you guys what, there's nothing to be frightened of there. Can you imagine it, though? You see that on the front porch, and you're like, ha, beware a cat, ha, ha. And you step inside, and you hear a loud, low growl, and you look over, and there's a mountain lion underneath the table. The guy says, oh, I didn't mean my puffy little cat out front. I meant my mountain lion to beware of. Anyway, listen, guys, thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.